This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Peter Adams of Rockies Venture Club. Peter, thank you for joining us.
Hall, it's great to be here. Thanks for inviting me.
Great. So what was your background before investing in early stage companies?
Well, despite being a finance guy now, I actually started as a philosophy major in school. And I have to say, I think it's a great background for venture capital, probably one of the best. But after that, I founded a computer manufacturing company in the mid-'80s and became a CIO before joining up with Rockies Venture Club on about 2011. And RVC, Rockies Venture Club, is the longest running angel group in the country. We've been doing this since about 1985. So we've got a lot of track record, and we're also one of the larger groups in the U.S. So we're doing a lot of fun things. We're doing a lot of our thesis is investing local. And so thinking about, how we have this sort of eat local restaurant type theme. Well, this is about investing local. And I think people really enjoy sort of taking their money out of Wall Street and putting it into companies that they can see and drive by on their way to work and see what's going on. So I think angel investing, most people invest within 100 miles of their home or office. So that's the local part is super important.
Well, that's great. You've seen it change over the years and looking forward to learning more as to how you think it compares today from yesteryear. But what excites you right now?
Well, I think in angel investing, one of the most interesting things to me is something that has become much more talked about recently, and that's impact investing. And I think there's a lot of reasons why it's interesting to me, but one is that there's so much misunderstanding about it, and it's such a promising area for angel investors. So just to be clear, impact investing, what we're talking about is social and environmental impact companies. So these are companies who are having an impact on either they're doing recycling or energy or healthcare or water, land, any of these types of impact areas, and they're also giving us market rate returns. So when we looked at our past portfolio, we found that about half of our companies we'd already invested in before we started thinking of ourselves as impact investors, about half of them were already impact companies. So we were sort of accidental impact investors when we started. So I think it's a really exciting place. And I think people really like having meaning in their money. And when they can invest in something that not only gives them a great return, but also they can see impact in their own communities, it's a great combination.
Great. Well, it sounds like you were well ahead of the curve there for sure. But so let's focus in on impact investing. What's your advice for people that are investing in startups in the impact sector? What do you tell them to do first before they write that check?
Well, I've seen a lot of people make some big mistakes when they jump into impact investing. And one is it's a super broad area. We talk about impact investing, but it runs the gamut from energy to healthcare. And so there's a lot of different places you can play in. And I think one of the things I see people make as a mistake as investors who are jumping into this is they don't get this distinction between what I call primary impact versus secondary impact. And this is super important. So in the Wall Street Journal this week, I was reading about ESG companies, and this is environmental and social governance companies. And that's what a lot of people think of. They jump to that when they think of impact. And the issue there is ESG is a set of metrics. And these are good things. It's talking about supply chains and pay disparity and diversity of employment and all of those good things. But it's measuring how the company works and not what it does. And I think if somebody's going to invest in impact, you want to invest in a primary impact company where what the company does is something really good in the community. And the problem with ESGs is they can be used to do what we call greenwashing your investments. And greenwashing is basically saying, yeah, I'm still going to invest in Exxon because that's an ESG company. But I think probably anybody who's interested in environmental impact is not going to be thinking Exxon is a good example of an impact company. So Exxon, ConocoPhillips, Coke, Clorox, Schlumberger, these are all ESG companies on the New York Stock Exchange. And it really sort of gives a bad name, I think, for impact investing to think of it in that way.
I see. So let's talk about impact investing. It used to be we all put money into nonprofits, but that seems to be shifting to impact funds. Talked to a lot of groups where they're shifting resource from one to the other. How do you see the industry evolving and what changes do you see coming up in impact investing?
Oh, that's a great question because we're like in a transition here where I think people started off thinking about what Ross Baird calls the two pocket program, where you have one pocket where you make money and you've got a certain set of practices and ethics around that. And then you have another pocket where you give money away with your philanthropy. And that separation of investment and philanthropy is not necessarily a healthy thing. In fact, if you look way back in history, like at Carnegie, so he has all these libraries and hospitals and great things that came from his philanthropy. But you look at the lives of misery that he caused from his workers and bringing out federal agents to shoot them when they were on strike. It was really unethical on that one pocket in order to create these wonderful things on the philanthropic pocket. So this diversification or division of impact and investment is now coming together. Some people are still confused. So you asked about what impact investors should be thinking about. One thing that's super important for them to think about is, well, I can get market rate returns, so I don't need to think of this as taking what in the industry we call concessionary philosophy, where we are giving up something. So as you know, as angel investors, we're looking for usually something like 10x in 5 years on our return on our investments. And a lot of new impact investors will say, well, I'm willing to get 2x or 4x as long as they're doing something good. And I think that's sort of a mistaken way of thinking about it, because if you think about it, these companies are doing good things. And so why should we give them permission to be smaller than they need to be? If they're doing good things, we want them to do more and more and more of those good things. And we should push them to have the same sort of scale and profitability and interest to acquirers that any tech company or healthcare company we might invest in.
Well, let's talk more specifically about your investment thesis for impact. What exactly is the thesis, and what's the criteria you look for when you see a startup to say, yeah, that fits what I want to do versus no, that's outside the parameters?
Yeah, so the thesis is important. For us, we kind of broke it into some chunks. So first of all, we're focusing on making top quartile returns for our limited partners. So it's a non-concessionary philosophy. And we're focusing our investments on primary impact companies, so not those SRI, ESG, or B Corps. And they're drivers of human growth, creating measurable impact in social and environmental sectors. And ones we like are things like healthcare, life science, education, clean tech, food, and employment security. So we're balancing high returns and high impact at the same time. And how we measure impact is one of the really important factors here in impact investing.
Well, great. Can you talk about one or two startups that fit that thesis?
Yeah, so we have a bunch, and I'll just give you a couple. One is Cirrus MD, which is a company we've been in for probably 4 or 5 years now, and it's a telehealth company here in Denver, Colorado. And the way I think about that in terms of their primary impact is every time somebody uses this telehealth service, they're reducing the cost of healthcare by keeping themselves out of the ER. But even better than that, they're allowing people maybe in rural communities or parents with kids who couldn't otherwise put the kids in daycare in order to come in and get the healthcare they need. They're able to get these things remotely. So, and this is a company, by the way, that had a Series B recently, and we're at about 15x already, and they're still going strong. Another one that has like 5 different kinds of impact is a Golden, Colorado company called PharmaJet, and they've developed this needle-free injection system for vaccines. So there's impact benefits there ranging from the fact that because it goes directly through the skin without a needle, it uses about 35% less vaccine than the old needle prick way of doing it. But it also allows people to get vaccinations who might have been needle phobic. So we get sort of community healthcare benefits when everybody gets vaccinated. I know that's somewhat controversial for some people. But also you don't get needle reuse, you don't get needle pricks among healthcare practitioners, and so on. So lots of benefits there. Another one out of Golden is Vartega, who's carbon fiber recycling. And they're taking things like the refuse from companies that are making huge things out of carbon fiber. And about 30% of the fiber that goes into manufacturing is wasted. And so this company, Vartega, has figured out a way to recycle those to be near virgin carbon fiber, saving a lot of energy, but also providing about half the cost for using carbon fiber for manufacturers. And the last one is a company called Opolis that's changing the future of work. And it's kind of interesting if you think about trends in how people work today. We're seeing more and more people in the gig economy, but they can't get insurance or can't get a 401k, and they're worried about making their deductions and quarterly payments to the tax man. Well, Opolis is sort of using a blockchain-based platform that allows, say you're a graphic artist and you work for 5 different companies, you can have just one company who is actually your employer, and that would be Opolis, and then all your payments would go into them, and then they would provide the healthcare, 401k, withholding, tax benefits, and so on. So these are really interesting companies, and all are 10x 5-year type potential companies.
I've heard some impact investors talk about the need for impact metrics. How much carbon did you sequester? How many plastic bottles did you pull out of the waste stream? Do you ever use impact metrics, or do you just look at what they do and know that that's going to be a good impact?
That is a great question. And I'll say that is probably one of the most difficult areas of impact, because some of the early impact metric systems that came out had difficulty with figuring out, should I make an investment in this company that provides a community with clean water? Or should I make an investment in another company that provides high quality education for those kids? So you ask yourself, well, which is more important, education or water? And it's hard to compare apples to oranges with some of those early metric systems. So now we're seeing some more sophisticated ways of measuring impact. So we can see relative from one investment to another how much impact a company is making. You still, of course, can't measure the value of water versus education, but we're starting to have systems where it makes sense and where you can start to evaluate, is this company really doing enough impact for me to dedicate my scarce resources to it? I'll just tell you a story is once you hang out a shingle and say, hey, we're an impact fund, pretty much everybody who comes to your doorstep is suddenly an impact company. And so every company to some extent has impact. So I think the metrics, if nothing else, are super important just for deciding where you're going to make your investments, because we've sort of developed a scoring system, a 30-point scoring system. And if somebody doesn't get 20 or more, then we think could be a great investment, but just not an impact investment.
Right. It just seems like those startups who know their numbers are just going to do better than those who don't know their numbers. But I do find some startups haven't really thought it through that, well, maybe impact investors want to know what my impact actually is, quantified. And I find many of them are out now looking for that, because that's important for some investors, just to know how effective it is and just to know your numbers.
Yeah. And I think investors are getting more and more sophisticated about that. And there are people who are super passionate as investors in one particular sector. So here in Colorado, we have NREL, the National Renewable Energy Labs. And so we have a bunch of people who really are sophisticated in their understanding and how they think about clean tech. And so they are thinking about, and that has some really good metrics about how many tons of carbon you're saving for these various projects.
Great. Well, you see a lot of startups in the impact space. What do you think the main challenges impact startups face in launching their business? Is it the fact that it's in an impact area, or is it something else?
Yeah, there are a number of challenges. And one, frankly, is just this sort of the still developing definition of impact, or the fact that impact is almost like that tale of the 6 blind men touching the elephant. And one guy touches the side, he says it's like a wall. Somebody else touches the tusk and says it's like a spear. And so they're all touching the same thing and coming up with a different definition or different understanding of what it is they're interacting with. And I think that is a problem in impact for companies. And so they need to overcome that by being transparent about how they think about impact and the sectors in which they're playing. But there's also challenges, and I've seen this now for well over a decade, where investors are doing a disservice to the companies they're investing in. And with all of the passion that they bring, and I appreciate that, a lot of times investors will give a hall pass to companies and say that they don't need to grow fast, they don't need to grow big, or even worse, they'll tell them that it's not important for them to be thinking about their exit strategies. Because if you could imagine, if you're maybe one of these impact investors who thinks of themselves as really a philanthropist, but I'm kind of investing, well, the exit strategy is kind of a dirty thing. Oh, well, that's where we're making money. We're not really here to do that. We're here to make a measurable impact. But I think for impact companies, talking about the exit strategy early is even more important than it is in companies in our tech portfolio, for example. And the reason is that they need to be thinking in advance about how they feel about the values alignment with the types of companies who might acquire them. They want to be acquired by a company who shares their values and is going to take whatever it is the startup is doing, and then with the acquirer's resources and R&D and channels and capital, be able to take that good that's happening in the world and expand it tenfold and make it huge in comparison to what that startup CEO could do if they were sort of holding on to it and just running that on their own. And so there's this whole sort of weird mythology in the impact world about zebras versus unicorns, and that somehow unicorns are, and as you know, a unicorn is a private company with $1 billion value or valuation or more. And a lot of the impact community says, oh, we shouldn't be looking for impact unicorns. And I find that just to be a mysterious thing. Why would you want to limit something that's doing such good in the world to make it this something smaller or something less than it could potentially be? So thinking about those exits and thinking always about how to expand what a company can do is important. And I think both for investors and for startups, they need to be thinking about it in that perspective.
Well, that's a good point. Well, you see impact in a lot of different ways, many sectors and applications. If you had to pick one or two areas you think it's particularly useful for, what would you call out today?
Yeah, so great question. One sort of standard that has come up in the impact world is the UN Sustainable Development Goals. And the UN a few years ago came up with 17 of these goals, and these define sort of what the impact community understands impact to be. And these are all great. And if we solved all of them, it would be a wonderful world. But we have to focus on areas that we have expertise in or that we can make the greatest amount of impact in. So there's a couple of places that I find really exciting right now. And one is the clean tech space. And clean tech has gone through a little bit of a tough, challenging period with energy from blue-green algae systems that didn't really work out. But now we're in the middle of a massive change about how energy is created and stored and distributed. And there's a huge opportunity to invest in bigger municipal level energy storage systems, as well as distributed energy storage on down to the household level, like the Tesla battery systems. But when you think about it, if you can have a municipal level battery or storage system, now you can take all of that energy you can generate during the day with wind or solar and then be storing in that and then releasing that at night. So now you can think about ways to drive down the cost per kilowatt hour, but also to wean yourself off of fossil fuels. So that's a big change, and that's going to take a decade or more to happen, but we are right at the turning point of that. And then flip side, on the healthcare side, we're seeing huge changes in DNA-based personal healthcare solutions. And I just saw a pitch yesterday that was fascinating. It was about a company who would take a sample of your DNA, process it through, and create a highly personalized drug that afternoon could be re-injected into you to solve personalized healthcare situations. So really, really cool stuff that's going on.
Well, that's fascinating. There's so much going on out there in the impact world, and it seems like there's just going to be more of it as we move into an area of solving climate change issues and carrying the population to the next level. So it seems like it's going to be a critical factor for what will take us there.
Couldn't agree more.
So in the last few minutes that we have here, what else should we cover that we haven't?
Well, let's see. There's so much. I'll just say there's a lot happening, not just in impact, but sort of in the major financial systems right now. After the meltdown in 2008, we saw a ton of new regulation in public markets, and it got really hard to have an IPO or to remain a public company. So here in Colorado, for example, we saw two companies that were public that went private last year just because they found it so difficult to work under all that regulation. And so what we're seeing is as the public markets go down as a source for financing for companies, private markets are increasing incredibly. So private equity is now almost a bigger player in new capital generation than the IPOs. So you see these sort of mega funds happening. You see SoftBank investing, hundreds of billions of dollars. And this is really changing how we think about about investing. And there's this trend of moving upward in capital where there's like the SoftBanks and these mega funds. I call it the gentrification of capital, where money is moving up and up and up to the later and later stages of investment, and it's leaving a gap. And it's a really important gap sort of at this angel seed stage. And while in the last couple of years, we've seen record numbers of venture capital invested in startups and in impact companies, we've seen that the amount of that is in the Series A and below has actually been decreasing. So this is a big challenge for us. And basically, if you think about it, if you're a venture fund manager, it's just about as easy to do diligence on a $50 million company as a $5 million company. So more and more people are realizing that it's more cost effective for them to just move upstream. And we need people like us who are in the angel and seed stage world, who are willing to do the work and take it seriously and make this be our primary job to start up these innovators who are really creating new solutions for social, environmental impact, but also just across industry. And this concept of startups being the new way that innovation occurs is really important, because if you look over the last decade, research and development dollars have been plummeting from companies, while M&A, mergers and acquisition dollars, have been on the increase. So we have the saying that M&A is the new R&D. And if you think about that, that really makes this angel investing phase super exciting as a sector to get into, because we're really where most of not only the job creation is occurring, but also where the new ideas are coming from that will come in and impact those larger incumbents in the industry in the next few years.
Yeah, it seems that biotech have been doing that for many years, relying upon acquiring the successful startups as opposed to doing all of the R&D themselves. And it seems like almost every industry is now adopting that model. It seems like it's much more pervasive than it was even 10 years ago, because startups are so much more adept at doing innovation than large companies, which are more oriented toward process automation. But it seems like that's where it's going in general.
Yeah, it is totally true. And you know what's fascinating? So you mentioned biotech. Biotech has sort of a bad name in the angel world because people think every new drug is going to take 20 years and $1 billion to take to market. And that may be true, but if you actually look at how biotech deals work, most of the time we're taking something through phase 1 FDA trials and then maybe phase 2. So we're really looking at about the same sort of a lifetime and the same sort of a capital requirement as we might for our typical SaaS deal. So we can be in and out in 5 years, invest maybe $1 to $5 million. And the upside on those bioscience deals is significant because, of course, those drug companies or medical device companies want to buy these de-risk things that have at least some of the pathway to FDA approval completed. So that's a big thing. The other thing we're seeing that's a huge trend is aerospace. And you think aerospace and angel investing, how would those overlap? Because you think, gosh, every one of these rockets costs hundreds of millions of dollars. But we're seeing tons and tons of cool startups that are coming out with new technologies, from different types of engines for propulsion in space to, we've seen a pitch recently for a space tug system that takes satellites from lower orbit to higher orbit, saving millions of dollars in these launches. So there's tons of things that startups can do in space, just like they can in bioscience, but of course exiting earlier before the project is really effectively launched.
That's very good. Well, how best for listeners to get back in touch with you?
Well, there's a lot of ways you can find me. I'm, of course, on LinkedIn, but you can also find me at rockiesventureclub.org and then also at rockiesimpactfund.com.
Great. We'll put those in the show notes and hope to have you back for a follow-up soon. Thank you for joining us today.
Thanks, Hall. It's a lot of fun. Love to chat.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Alti Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.